I love market corrections. Stocks and ETFs are cheap, investors are panicking, and you're there wondering how you can find more money to invest at a discount. Yes, because market crashes and corrections are exactly how rich investors get richer. So today, I'm giving you a game plan. Not just the usual tips, but 10 real actionable strategies to turn this market correction and also the future ones that we're gonna see this year into your biggest wealth building opportunity. My name is Rick, your favorite Italian investor and twin of Manu Ginobili. And after you're done dropping a like to this video, let's dive right into the first tip to get filthy rich out of this market crash. Now, the first thing I want you to do is steal from the dump. I know. It sounds highly unethical, but it's not. If you haven't heard of dump money is the perfect blueprint that you need to not follow if you want to make money. Every time the market crashes, the same thing happens over and over again. Dumb money runs against the wall, smart money gets richer. So if you don't want to be the dumb money, but you want to make money off of them, here's how you do it. I present to you the dumb money confidence chart and the smart money confidence chart. To find these charts, you just need to Google sentimenttrader.com, dumb money, or sentimenttrader.com, smart money. But how can we use these charts to our favor? Let's start from the dumb money confidence chart. Set the end date to today, which for me is the day of recording, and you see here this line that goes up and down, moving from 0 to 1. The higher the value, the higher the confidence of the dumb investors in doing the wrong things. All right. It's not so nice to call them dumb investors because actually a more accurate description would simply be trend following. Following trends though is never a smart move because by the time most people hop on a trend is about the time the trend is becoming exhausted. Think about all the people that before 2022 were jumping on AI stocks just because AI was trendy. They didn't end up well in 2022. So what we want to do is we want to do the opposite of what the dumb money is doing when they are in an extreme. Usually, the dumb money confidence stays within the range 0.3 to 0.7. If it gets closer to 0.7 or goes above 0.7, then it's the perfect moment to do exactly the opposite of what most people do. Look at these two periods of time. One in 2022, when the market was declining, as you can see up here, and one between 2023 and 2024, when the market was actually growing. At the beginning of 2022, the dumb money confidence was extremely high, signaling that what people were doing was wrong. In fact, in 2021, everybody was buying and the market was on a bull run. Looking at this value, a smart investor would have known that buying more was actually wrong and would have sold before the crash. During the crash of 2022, the dumb money confidence obviously went down, which instead should signal a good investor to buy because you can buy at a discount. In fact, all the moments the dumb money confidence was at the lowest values, even lower than 0.3, were the best moments to buy. Every time the value was at the highest level, even here during the crisis of 2022, were the worst moments to buy. In the same way, you can see that starting from the end of 2022 until the end of 2024, the dumb money confidence tended to grow more and more and stay more frequently into high levels, signaling that instead the market was getting overvalued. In fact, we know that in 2025 the market dropped. In general, the more the dumb money confidence grows, the more you should be afraid of buying. The more the value drops, the more you should be confident of buying. The smart money confidence instead does exactly the opposite. You'll notice that when the market is overvalued, like at the end of 2024, the smart money confidence is low and the dumb money confidence is high. On the contrary, after a long bear market, the smart money confidence is going to be really high and the dumb money confidence really low. So the lessons here is clear. Do the opposite of what your instincts tell you. Do the opposite of what trends tell you. Applying this to today's situation, the smart money is going up and the dumb money is going down, which gives a signal to buy. Obviously, consider that the market can go more down than it did so far, and in my opinion, it will. But generally speaking, by buying when the smart money is up and the dumb money is down, you're most likely buying in moments in which the price is down. Second tip is avoid the normal DCA, use tactical DCA. In other words, don't just buy every month, buy smart. I always advocate DCA or dollar cost averaging, but I believe that there are some moments in stock market cycles where you need to be a little bit more creative, and market crashes are one of those moments. Now, it's totally okay to set up an investment plan that blindly buys the S&P 500 every month on the same day, but when there is a market crash, we can do better. Instead of investing the same amount every month, do this. If the market drops 5 to 10% in a week, double or triple your buy. If the market is flat, buy your usual amount, and if the market is overbought and rallying too fast, hold more cash and wait. This way you're loading up when stocks are cheap and holding back when they're expensive, without trying to perfectly time the bottom. For example, between mid-February and mid-March this year, while the market was going down, I bought more and more. But as soon as the market flattened and showed some sign of recovery, I started buying less. So simply buy heavier when the market is panicking to get a lower average cost and make way more money when stocks recover. And boom, here you have it. Tactical DCA. Smarter, more profitable, and easy to implement. The next strategy is my readaptation of the barbell strategy. I call it the adaptive barbell strategy. Most investors use the same investing strategy no matter what the market is doing. But smart investors adjust their approach based on where we are in the cycle. That's how you maximize gains and protect yourself from getting wrecked. So, here is the smartest way to do it. In normal markets, stick to broad-based ETFs. When there is no panic, no euphoria, during periods of steady, boring growth, the best play is broad market ETFs like the S&P 500, like SPY or VO, or total market ETFs like VTI. These give you a solid exposure to everything. And since there is no obvious discount or bubble, it's best to stay diversified. You're not looking for huge gains here, just steady compounding. But in market crashes instead, load up on growth. Crashes are where fortunes are made, but not by throwing money at everything, but buying the right things. Growth stocks and tech-heavy ETFs get hit the hardest in downturns. And that's because they have the highest valuations in good times, so when fear takes over, they collapse faster than the rest of the market. This is when you lean into high-quality growth ETFs like QQQ, VGT, or SHG. You're not buying hype, you're buying real companies that got unfairly punished just because the market is in panic mode. When the market is going great instead, and above all when it's going great for a long time, like in the 2 years 2023 and 2024, rotate into value. In fact, these are the periods where growth stocks become dangerous. This is when FOMO takes over. Fear of missing out. Valuations get ridiculous and everyone is piling into the same speculative names. So instead of chasing the bubble, pivot into value ETFs like SHD, VYM, or dividend-paying stocks. These are the stocks people ignore in good times but come running back to when the hype fades. Tip 4 is what I call survivor stock picking. I'm not an advocate of stock picking, but market crashes are a particular moment. Market crashes don't just destroy weak companies, they reveal the strong ones. When everything is falling, it's easy to think, everything is doomed. But in reality, downturns separate the real winners from the hype stocks. So look for companies that took a hit, but are still dominating. The best stocks aren't the ones that never drop, the best stocks are the ones that drop and then come back stronger. So here's what to look for. Revenue and profits are still growing even if the stock is down. High cash reserves and low debt that shows that these companies don't need bailouts. And look for market leaders in their industry. Think about 2008. Companies like Amazon and Apple got crushed just like everyone else, but their businesses kept growing. Those who saw that and bought them cheap made a fortune. But unfortunately, I was too young and stupid to invest. And by the way, avoid what I called the walking dead. Just because a stock is down 80% doesn't mean it's a bargain. Some stocks never recover. And that is the terrible mistake that I used to do at the beginning when I was buying stocks during market crashes, because I was always looking just at how much stocks went down instead of what their future potential was, just as if I was sure that they would have gone up again. To avoid companies that won't make it back, avoid the ones with high debt or that burn cash with no clear path to profitability, like unprofitable tech stocks that need consistent funding. Peloton is a clear example of a company that crashed in 2021 and then just kept sinking. Well, let's move to tip number 5 now. Everyone tells you to hold cash during a crash. And they're right, but there is a smarter way to do it. Holding cash doesn't mean stuffing money under your mattress or letting it rot in a savings account earning 0.5% interest. Even Warren Buffett, who is famous for hoarding cash during downturns and now is holding more than $325 billion in cash, doesn't actually hold cash the way most people do. Buffett holds cash as short-term US Treasury bills. These are basically risk-free investments that earn him a small but steady return while he waits for opportunities. To do something similar, you could buy short-term US Treasury ETFs like SGOV, BIL, or SHV. They are as safe as cash, but actually earn you something. Other options include highly liquid dividend stocks that generate income while you wait for bargains, or high-yield savings account, which are bank accounts that pay high yield on your savings. Currently, you can find high-yield savings accounts that yield between 3.7% and 4% per year. Tip number 6 is reinvest your dividends. Market crashes are painful, but getting dividends while the market goes down is quite pleasant. This is why dividend reinvestment is a secret weapon during downturns. Instead of just watching your portfolio drop, you keep collecting cash cash flow and use it to buy even more shares at lower prices. Dividends are particularly important in a bear market because when stocks are crashing, price appreciation slows down. But dividends, they keep rolling in. Reinvesting dividends at lower prices means you're automatically buying more shares when stocks are cheap. And by the way, dividend yields go up when prices fall, meaning you earn more for every dollar invested. The best dividend strategy during a crash is to focus on strong dividend growers. Look for companies with a history of increasing dividends even during recessions. Either you get all these companies together with an ETF like SHD or VYM, or you buy individual stocks like Johnson & Johnson and Procter & Gamble. And by the way, avoid high yield traps. Some stocks and ETFs have insanely high dividend yields because their price collapsed, but the business is failing. If you can, use a so-called DRIP or Dividend Reinvestment plan. And many brokerages let you automatically reinvest dividends instead of taking cash. This makes compounding effortless. Moving on to the next, most people panic during a market crash because they don't know where to put their money. But here's the truth, not all sectors crash the same way. Instead of selling everything or guessing which stocks will survive, you can use recession-proof ETFs to ride out the storm and even profit while others panic. But now, what makes an ETF recession-proof? There are certain industries that thrive during economic downturns because people still need their products and services no matter how bad things get. These include healthcare, because people still need medicine and medical treatments, consumer staples, because no one stops buying groceries, toothpaste, or soap during a recession, and utilities, because people still pay for electricity, water, and internet, even in bad times. These industries provide steady profits and dividends even in a bear market. That's why their stocks, and the ETFs that hold them, tends to fall less and recover faster. Tip number 8 is what I call the mega cap safe growth strategy. Everyone wants to buy high growth ETFs, but during a market crash, we all get a little scared when our growth companies fall down to the drain. And that's why, during market crashes, big companies like Apple, Microsoft, Google, or Meta are a better choice because you know that they are going to be relatively more stable and are not going to go bankrupt, even if they are growth stocks. Mega cap growth is a smart play in a crash because they dominate their industries and they can actually gain market shares during a crash because while weaker companies go bankrupt, mega caps acquire them or expand. If history tells us anything, it's that the following giants tend to bounce back faster and stronger. Tech giants like Apple, Microsoft and Google, or Amazon and Meta. Consumer giants like McDonald's, Procter & Gamble, investment companies like Berkshire Hathaway, and if you don't want to pick individual stocks, ETFs like VGT, the Vanguard Information Technology ETF, QQQ, the Nasdaq 100, and SHG, the Schwab US Large Cap Growth ETF. Tip number 9 is what I call the inflation hedge play. More often than not, market crashes come with high inflation. And if you're not hedged, inflation quietly eats away at your buying power, even if your portfolio stays flat. Right now, inflation isn't running wild like it was in 2022, but that doesn't mean we can ignore it. The Federal Reserve is holding interest rates steady. That means inflation isn't necessarily going to surge again, but it also means that it's not fully crashed yet. So here's what you can expect from 2025. If the economy stays strong, inflation could stick around longer than expected. If the Fed keeps rates high for too long, we could see a slowdown leading to a recession. If the Fed cuts rates too soon, inflation might reignite. This uncertainty means you need to be prepared for different scenarios. And since inflation isn't necessarily about to skyrocket, you can just go all in on inflation hedges. Still, you should have some protection in place. To find protection against inflation, you can invest in commodities and energy. ETFs like XLE, the Energy Select Sector, and DBC, Commodity Index. Another thing you can look for are dividend stocks and pricing power stocks, companies that can pass on higher costs to consumers. Imagine companies like McDonald's, Coca-Cola, and Procter & Gamble. Then in case of inflation, can just raise prices to pass inflation along to consumers. And if inflation drops instead, tech and growth stocks will likely outperform. So if you see inflation dropping in the next months, shift some allocation towards ETFs like QQQ. The last tip, and this might be the most important move of all, prepare for the Fed pivot. The Federal Reserve has been raising interest rates aggressively, and since last year they started reducing them, but really slowly. The last cut was in December last year, and now January and February and March we haven't seen any cut. So at some point they're gonna start reducing them strongly. When that happens, the market won't just recover, it will explode. So are you ready or are you not ready to make some money this year? Remember that in my opinion, we're not at the bottom and this year will keep being a difficult year for investors. Nevertheless, this also means that you're going to have many opportunities to buy at bargain prices, So I hope that these tips I gave you are gonna be useful for you, and if you think they are, drop a like and subscribe to my channel. I wish you a great day everyone, and as always, I'll see you in the next video. Ciao!